Thanks for tuning in to another episode of the Macrocast. I'm your host, Ylan Mui, a managing director at Penta. My co-hosts are Brendan Walsh and John Fagan of Markets Policy Partners. Hey, guys.
Hi, Ylan. How you doing?
Good. Well, I'm doing better because things are definitely looking up in Washington now that the debt limit has been lifted. But maybe it's not looking so hot in the rest of the world. The OECD has released its updated economic outlook, and it's now projecting that global growth will slow from 3.3% to 2.7% this year, and then basically flatline next year. The forecast for growth in 2024 is 2.9%. So I guess if I'm looking for good news here, maybe it's that the OECD is not saying we're going to be in a global recession, either, across the world or even specifically in the US, but those numbers are still looking pretty mediocre, guys.
Absolutely. I mean, I don't want to sound like a cynic, but, when you have your forecast and outlook like we do at Markets Policy Partners, and it's for, relatively significant slowing in the second half of the year into recessionary conditions, not a deep crushing recession, but a relatively mild but lengthy recessionary period in the U.S. and the globe in the second half of the year. And then all of a sudden you get these big big forecasts coming out and aligning with your view. That always makes you want to go back and revise your view. It's economics have a way of, when consensus, particularly big institutional consensus, centers around particular outcomes, that's when you want to take a second look.
You're mad that they're agreeing with you, John?
Well, it's consensus. Economics is very cruel to consensus, right? And consensus forecasts are notoriously wrong to a great percentage of the time. So, the fact that the OECD and the World Bank have issued, downgraded and sort of, darker predictions that align with our views doesn't necessarily, validate those, and it makes us want to unpack the assumptions behind them. And, very much like, our view, it's lagged effects of tightening, persistent restrictive conditions from global central banks, and a sticky inflationary dynamic that continues to, soften up the consumer rather than, some sort of knockout blow, but, little by little incrementally wearing down the consumer's dry powder and savings and so forth, and creating a bigger challenge as we go along, compounding difficulties on the demand side. So that sounds an awful lot like ours, maybe this time the big institutions will be right.
One thing I thought was interesting is that in their forecast, they said that the risks are weighted to the downside. Obviously, who knows what Russia's going to do? Hopefully that resolves. But if it doesn't, that's obviously another potentially big shock to the global economy, but also because of monetary policy. So on the one hand, John, you could say that there is room to be even more pessimistic. They're giving themselves room to be even more pessimistic than they are now. And maybe that's the space that you guys will end up playing in. But it was also interesting to me because I felt like the markets had been expecting the Fed to have to cut rates quickly because they had tightened too fast. And it seems like what the OECD forecast is saying is that actually we are still going to be really feeling the effects of the Fed's tightening cycle next year, that this lag is maybe even longer than we thought. So I thought that was an interesting divergence between what the OECD was saying, which is we really haven't even begun to feel the brunt of it yet, perhaps, and what the markets are saying, which is the Fed has already gone too far.
Yeah, there was this kind of mea culpa moment from the OECD where they said, hey, the economy has stayed more resilient than we expected. So they actually, and that's something that the World Bank did. The World Bank moderately upgraded their forecast for this year from 1.7% to 2.1%, and similarly, there was an acknowledgement by the OECD that we've seen resilience that we didn't expect, and so there's a lot of there is a lot of uncertainty, but this is something that as we pointed out, the divergence between where Fed fund futures, the futures markets, and the markets viewpoints have been, and where the pricing has been, and where the Fed higher for longer has been clashing with these priced in rate cuts through the back half of this year. Now, I think, over the past week and week and a half, 2 weeks, that has changed to a significant degree. We've been seeing, 50% odds of a rate hike starting as soon as September. That would be a neck snapping pirouette, even for, the Powell Fed has, had some pretty rapid policy shifts in their tenure, but this would be, a whole different order of magnitude. And so that has been priced out to a great degree. We've seen that come through in the yield curve. The 2-year yields have come up a lot. That's dragged up the whole yield curve to some extent, and there's still there's still rate cuts priced in, but December kind of looks like a coin flip and is dependent on whether they do one more, and it's really 2024 when the cuts have been shoved out to 2024. We think that that's probably the right idea, and as again we're sort of on the same side as the OECD, World Bank, that this will continue. The tight monetary conditions will continue to be a drag and sort of a cumulative effect rather than seeing it all at once.
Brendan, one of the things that we've talked about playing out here in the U.S. is the impact that tighter financial conditions, tighter bank lending is having on consumers and the sort of ripple effect that might have for Fed decision making. Are we seeing the same thing play out, I guess, globally in terms of are we seeing global tightening of bank lending, and is that restricting economic activity into 2024, do you think?
You're definitely seeing the same in Europe, and kind of the same type of companies in the United States that are raising some warning signals about the consumer are the similar ones in Europe. Asia's been a little different beast. China's kind of its own entity going on. They've got their own kind of their own economy and issues, especially being so far behind the curve on the COVID scale. But the rest of Europe seems to be doing. The rest of Asia seems to be doing okay. The Bank of Australia actually delivered a surprise rate hike. They were one of the first that kind of pulled back on and stopped their hiking a few meetings ago, and they saw kind of enough inflationary pressures, but also strictness in the labor market to justify a 25 basis point hike. I think what really worries me in terms of a mistake on especially the Fed, is I don't really think they understand what's going on in the commercial real estate market. We're starting to see some defaults, but the more important part of the issue is it basically a third of commercial property in major cities will never be used again. It's completely worthless, basically. It's only worth what the land underneath the building is. It's very difficult to also convert a commercial real estate building into a residential. They have different plumbing and air conditioning, ramifications. So we're starting to see, some commercial real estate loans go default. And what happens is when they get put back to the bank doesn't want it because they know they can't fill it, and it costs a lot of money you have to pay taxes on it. You have to air condition it. So the bank it really puts it on the market for whatever the land underneath that building is worth. So there's huge losses coming, and the people that hold that are pension funds and the life insurance sector. We talk about the stock market, but the stock market is actually very, very small in terms of size, and there's just too much money you can't as a pension fund you have to be in real estate in order to just literally find enough things to invest in. So this is a big issue, and the Fed is very much exacerbating the issue with keeping rates as high as they are, but also if they're going to keep going higher, then they're going to bring that pain, closer to the future. I don't think they understand that at all. They very rarely talk about the commercial real estate market.
Yeah, I think that is a potential big risk out there. I feel like even now, still, when I walk around DC, not today when it's still so smoky and hazardous outside, but generally speaking, when I've been walking around downtown DC, I'm still surprised at how many places are closed, how many lunch spots are empty or just partially full. I mean, it's still so different from what we think about how the world looked just a couple of years ago. But it seems like at least on the residential side, maybe there's a little bit of stability now in terms of mortgage rates and where the housing market is. This week, the Penta Civic Science Economic Sentiment Index came out, and actually it showed a pretty decent increase in terms of how consumers feel about the U.S. economy. Confidence rose 1.7 points to 33.3. That's the second biggest reading so far this year. But also the other factor that contributed to improving sentiment was your confidence in buying a new home. That actually ticked up 0.2 points to 23. So it kind of seems like maybe consumers are feeling like we have seen the worst of the mortgage rate rises, and, demand is still strong for homes. Supply is still limited. And so folks are still wanting to get into the market.
Well, that's the issue. I think the buyer has adjusted to the new higher rates, and also I think they're confident in their job prospects. So they've kind of readjusted things. The issue for the housing market is there's just no supply. Everybody that has a 2.5% 30-year mortgage, the bar is really, really high to sell your house and move. So we're just seeing house prices kind of stabilize, but it's very simply that there's just so few transactions happening that we haven't been able to kind of clear the market and find a new healthy equilibrium.
Yeah, I'm not moving. I'm staying in my home, right? And so many people refinance, right? So they're at the beginning of their 30-year mortgage as well. So that's an issue. But I also think that this speaks to the durability of the consumer that you guys were kind of referencing there in the Bank of Australia's rate hike, because one of the things that the OECD did mention was that central banks should not reverse course until they see durable signs that inflation is coming under control. And so I guess they're sort of warning against starting to pull back too soon, because what we've seen is that the consumer is still strong, the economy is resilient, and that means inflation is coming down perhaps more slowly than folks had expected.
Especially on the service side. Goods inflation has kind of found its new normal. Though we now have another strike at the Port of Los Angeles, so ships are backing up. So you don't want to call victory too soon, but hopefully they can get that worked out. We don't have to go through another goods supply chain caused inflationary pressures. But people have been pretty excited to go back out and go on vacation, go on cruises, and go to hotels and go to restaurants. So that demand is definitely. It's not that the service sector inflation is out of control. It's just been a little stronger than probably the Fed had originally envisioned. But, we do get data, private sector data, from the payroll companies. And they have said that the wage inflation has come down dramatically in the last 2 months. We're back to basically where we were on a year-over-year basis in terms of wage growth. We're back into that 4.5% range. So that's a good sign that, we're not going to get a wage-driven spiral. There's also research from the San Francisco Fed that said wages really have nothing to do with inflation. So that's something the Fed can discuss at their next meeting.
So let me ask a philosophical question here. Okay, so if the economy seems to be persistently stronger than folks are expecting, or that the economists are expecting, but yet folks like us, the chattering class, if you will, keep talking about recession, wondering about recession, worrying about recession. Is it possible that we are trying to just convince ourselves that a recession is coming, and maybe it doesn't happen at all, and the soft landing is actually the most likely path?
The form that a recession would take, right? We've just seen this. The dynamics are so idiosyncratic, and to have pronounced weakness in certain pockets of the economy. I mean, look at manufacturing. I mean, this is a really pretty dismal outlook. The purchasing managers
generally been in a recession for the last 3 to 5, 6 months.
Yeah, and you look at some of the leading indicators. If you're looking at the electronics exports, if you go, cast your eye further up the supply chain and look at electronics exports, from South Korea, Taiwan, they look horrible. And, it's just this, there's a lot of demand.
Shipping rates, the ships that are carrying those things, they're back to all-time lows in terms of the cost.
Commodity prices look really soft. Chinese growth has been dismal. They are trotting out this new stimulus package to go on top of the previous stimulus package they announced in January, which didn't do very much, obviously. And,
and John, we had Saudi Arabia caught on their own because they see, the demand so weak. Oil prices popped for a couple of days, but now we're kind of stabilizing where we've always been.
Yeah, the oil price rally post the unilateral Saudi cuts was like a one-day wonder. And that's, there. And of course, our old friend, the inverted yield curve. So, you can look at the equity market and say, my gosh, it's incredibly resilient. And then you open the hood and it's being driven by 12 stocks, right? And an equal weighted S&P 500 is down or flat on the year. Whereas the main index is pretty substantially higher. What's the S&P is up year to date? Yeah, year to date up almost 12% and just seems to be going great guns. But, most of the stocks are not driving the bus here. And so it's a very, it's a Rorschach test, right? It's like an ink blot. If you're of a mind like we are, where we're thinking that a recession is on the way, boy, you can amass a serious amount of evidence to support you. But, there are a whole lot of things to the contrary as well. And it just speaks to this disjointed, multiple economies all in one. And it's really difficult to see how it's going to shake out.
Well, maybe this is why the central bank's policy setting meeting lasts for 2 days and not just one. They have a lot to talk about, and so do we, but we're going to take a short break for right now. When we come back, we'll look at some other recent central bank moves as well as look ahead to the FOMC meeting. Don't go anywhere.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
And we're back with the Macrocast. The Bank of Canada surprised markets by raising rates by 25 basis points after a long hold. John, what prompted that pirouette?
Yeah, it really took traders completely by surprise. Or, there were maybe, small percentage that were thinking that we would see a rate hike after two meetings on hold, March and April. They didn't go anywhere. And there was really, no foreshadowing of that kind of move. And when they did it, it was excess demand was the culprit, right? I mean, it's not as though inflation is necessarily flashing red, but the underlying conditions in the economy were deemed just too strong. And that's, that gave, traders around the world a sort of a cold shiver down the spine because, even the idea has been that, well, inflation is going to come down and then the Fed, as soon as they get they can draw the dotted line and their models are telling them that they're headed to 2%, they're going to be cutting to offset weakness in the economy. But, the Bank of Canada proved here that strong demand, excess demand can justify a hike just as easily as sticky or high inflation can in the minds of some central bankers. And this, it had a significant impact spill over into the Treasury markets. And, there's still a lot of questioning about what's going to go on at the next meeting. And with the CPI number and a bunch of economic data coming out ahead of the decision, it's really going to be there's a potential for a lot of movement on where the rates land next week.
Yeah, I think the difficult thing for Fed watchers, for the markets to try to process is that if the Bank of Canada is going to have this sort of stop and go policy, right? We're going to raise a little bit here, wait a little bit, raise a little bit more, maybe raise a lot. It's hard to see what the arc of increases might be. I remember, after the Fed tried to get off of the zero lower bound, they said monetary policy is not on a preset course. Every meeting is going to be data dependent, et cetera. That's when all that language started to come around. Yet by their actions, when they were raising very predictably by 25 basis points every single meeting or every certain number of meetings, they said one thing, policy is data dependent, but they acted in a very different way where policy seemed to be on a preset course and it would take a lot for them to change their minds. In this situation, what you're seeing out of the Bank of Canada is that maybe every meeting is actually a jump ball. And I wonder what that means for Fed communications and the way that the Fed can instill in markets the confidence that they actually have a plan and they're not just reacting.
Yeah, and one of the problems for the Fed at this meeting is they did really lay the groundwork for a pause. They gave speeches, and then they also, leaked it to the Wall Street Journal. Fed watcher, that's kind of the voice. If it gets to Nick Timorous, usually that came from the Fed. But then we got a really strong jobs number, and now they're kind of like, I think they kind of painted themselves in the corner. And I do also think it makes a lot of sense to just take a pause for the summer, see how things are, and then reassess things, in September. But there are a number of hawkish voices on the Fed that, are going to disagree with that. So it's going to be a much more difficult meeting than probably they thought it was going to be 2 weeks ago.
Well, and also I think part of the problem too is that 25 basis points or not 25 basis points doesn't really make a huge difference in terms of the impact to the economy, right? It's really their messaging over where are we headed. And if they're turning the dial by, inches in each meeting, does that really give the market a good sense of where they're heading? And if that trajectory is really what makes a difference, then are they even doing anything by turning the dial just a little bit each time?
Right. I don't think the Fed is worried about what's priced in for this meeting. What they're worried about is what's priced in for the back half of the year, all the cuts. And they really want to send that message that we're being cautious to not over-tighten. But by not over-tighten, that means we're going to stay where we are for a long, long time, much longer that's priced in the market. So I think now with the strong jobs number and now with a couple of other, decent-sized central banks hiking, that message is going to become much more muddled. And they're going to have to, if they do decide to pause, it's going to have to be a hawkish pause.
And the Fed's not the only one that's grappling with this decision. Obviously, central banks around the world are, but I think the ECB also has an important meeting coming up as well.
And this is the ECB GDP data this morning that showed that in the first quarter, the economy, the Eurozone economy contracted.
But the hawkishness from the ECB leadership has been unabated, essentially. I mean, they've got a lot of rate hikes priced in through the end of the year. I mean, we're talking like 50 or more basis with upside risk in their hiking cycle from here, which is, I think that's what the ECB has been guiding for. And, you've seen, again, there's certain elements of the like service sector PMIs and that sort of stuff and sticky inflation dynamics that would point you in that direction. But, there are plenty of others. As you said, the contractionary overall GDP and
also we got a revision. So the fourth quarter contracted also. So you have, 2 quarters of contraction. It was only down 0.1%, but it still was negative.
Yeah, it would be a surprise to us if the ECB can, with, let's say the Fed goes on hold in June and we have continued mixed data but trending lower inflation and so forth. Is the ECB under the current economic conditions really going to be charging ahead with another 50 or 75 basis points of hikes through year end? It's a little hard to see, but that's what they're telling us now. But again,
yeah, and they've had a very unified message. They really don't have anybody speaking out of tone in Europe. So they're all on the same page. So it'll be interesting to see how that plays out.
Sure. But of course, there's always that aspect of, their verbiage may be the old open mouth operation, right? Yeah. It's not, instead of the open market operation, that's, a little verbal jawboning, make sure that everybody sees what's coming. But there are lots of variables. And we've seen, the idiosyncratic impact from the weather, the idiosyncratic impact from what's happening in Ukraine. Ukraine and the terrible, latest developments, escalation, and the environmental and personal catastrophe that's going on after the dam bursts and wheat prices going up after that. It's the striking ports. We live in a fat tail world, and and that's and the global central banks are at a position where they're still leaning toward more hikes, but we're by any sort of rational metric, we're close to the pinnacle of global rates. And as you said, Ylan, another 25 basis points here and there, does it really matter? But it does matter, as we said, for that signaling aspect for the longer future. That's something that the market really hasn't digested. We just have learned again and again, when things get bad, central banks loosen, and then you can let the good times roll and buy more Tesla stock and and feel good about the world. But that cycle may not persist into these coming years.
How important do you think energy prices are to the ECB's decision? We've seen energy prices come down somewhat in Europe, but if they were to come down further, and let's say the escalation in Ukraine ends up abating, Saudi cuts notwithstanding, how much does that factor into to the ECB's decision? Or, are we just not going to see energy prices fall much further given all the other things that are happening in the macro environment?
Well, we've seen, certainly in the natural gas, that was the big Achilles heel in Europe. And, we've seen those prices come down a lot. But we've heard a lot of hand-wringing about, we got through the first, we got essentially through the first winter. But it's really the next winter that is going to be, potentially an even bigger problem, because you just don't have the same kind of cushion that you might have had going into it and so forth. It's got to be in the backs of their minds that this could, still have this energy prices could still have significant inflationary potential in the coming seasons. Last winter, everybody realizes just how lucky Europe got with an incredibly warm weather pattern across the continent. And if that's not repeated, and there's still, and you're going in with, less of a cushion, then who knows what could happen. Also, Russia, presumably, if we're going into, if conditions stay the same, Russia's going to be even more desperate in the coming season. But we've seen in the oil world, they're not willing to cut production, and so it has, on some level, maybe these sort of economic and commodity warfare, withholding energy from consumers is certainly a lever they can pull, but it's self-defeating in certain ways. And that was one of the pieces of news from the OPEC meeting, is that Russia ain't on board with any further cuts because of their own fiscal finances. And that's, maybe that logic begins to apply more in the natural gas, but it's so hard to tell.
Well, all of these global dynamics will be swirling around in the minds of Fed policymakers when they meet over the next week. Is there anything else in the agenda that we should be paying attention to?
Well, we heard, the reports earlier this week that the likelihood, of the attention to banks and the likelihood that bank regulation was going to lead to higher capital buffers. Brendan, what did you make of that set of reports?
Just that, the way that Dodd-Frank is structured, the Fed has a lot of leeway, and that these new higher, ratios could come as early as, at the end of the summer. This isn't going to be one of those things that's going to take, 2 years and lots of comments to come. And the CEO, Brian Moynihan, the Bank of America's CEO, yesterday just kind of gave numbers to what it means if he has to hold $100 billion more in, treasuries, what that will do to his lending book. So that's another thing that the Fed hasn't in its control. If they want to raise capital ratios, they will massively lower the amount of loans that are in the U.S. economy. We also had speculation today that the White House denied, but there seems to be some smoke there, that we are coming close to a Iran nuclear deal.
Yeah, when you say smoke, there's a lot of smoke floating around these days. Yeah, there's certainly there's more smoke than fire on some of these. But that would be interesting if there's an Iran nuclear deal and at a very at a time when clearly the global geostrategic chessboard has been thrown up in the air, and it seems as though the news also that Secretary of State Blinken is putting potentially the visit to China that was bumped by the spy balloon incident back in February back on the calendar.
Yeah.
It's kind of, with the domestic agenda for the Biden administration, obviously like now in stalemate with the House Republicans. Well, the House Republicans kind of at each other's throats. Nothing's getting done now that we're on the other side of the debt ceiling. It certainly seems like an auspicious time for the White House to pivot toward, some of the, obviously keep going with their, ballyhooing their infrastructure accomplishments and the incremental spend out of the major fiscal bills, but focusing more of their energies on the global and foreign policy space, which is clearly very, very volatile tinderbox at this point.
Well, we can keep talking about these issues all day. And in fact, we will keep talking about them next week. But that's all the time that we have for now. Thank you all so much for joining us. Thank you for listening to the Macrocast. I'm Ylan Moy with Penta. My co-hosts are John and Brendan from Markets Policy Partners. We hope you enjoyed the show today. And please remember to like and subscribe to the Macrocast wherever you get your podcasts. Have a great day, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.